Good morning, everyone, and welcome to today's webinar where we are talking all things HMO with our good friends at West One. My name's Jason Berry. I'm Group Sales and Marketing Director here at Crystal. I'm not Chris Corns, our regular host for those who do tune in to these each month. Chris has unfortunately got a sore throat, which his wife's probably happy about, but yeah, because he's lost his voice, but obviously we were no good for today's webinar. I'm joined today by Annette Tilbury, National Account Manager for Buy to Let from West One. And how are you doing, Annette? No sore throat, and hope you're fighting fit.
Yeah, very well, thank you.
Great. Listen, thanks for your time and sharing the expertise that you guys have got at West One. I mentioned you're one of our favourites, and that's certainly the case when it comes to HMOs and buy to let. So I know we're going to explore that as we go through the next 50 minutes or so. So for those of you who are familiar with these webinars, and for any first timers out there, we absolutely love questions. So please use the Q&A button at the bottom of your screen to ask any questions that come to mind during the webinar, and we'll make sure that we really do our best to answer those. Even better, if you've got any cases that you would like to place and have been teetering on the brink in terms of moving forward, then please let us know, and we'll certainly cover them in the Q&A. So the more questions, the better. But I suppose just to start us off, Annette, just look, I know we always get a range of attendees on these particular webinars. So you just bring us up to speed with exactly what a HMO is and just how it's different to maybe a standard buy-to-let.
Yeah, sure. I mean, basically a HMO is shared facilities. So generally you're talking 3 or more individuals where they're from different households, whereas a single let property is generally maximum of 2 individuals and generally just one single family. So they will use the bathroom, shared kitchen, etc., and have their own bedrooms within the property.
Okay. What about the benefits of a HMO? So why should the advisor and the guests listening, why should they consider HMO and understanding the benefits?
Yeah, I mean, I guess the first one that springs to mind for most property landlords is the increased return, because generally HMOs will generate much better income for you than just a single let property. So that's probably the major one that everybody thinks of straight away. Also, even if only part of the property is let, then generally you're covering your mortgage payment. So you've got less of an issue with arrears and things like that. And voids, if you get the odd void, then they can be filled fairly quickly because there seems to be a lot more demand for people having affordable accommodation. So less people are actually able to fit the criteria needed to be able to rent a property on their own, and therefore this is a safer option for them and more affordable for them.
Okay, and what about the risks involved in a HMO?
Well, obviously, when you're renting a property to more individuals, you're going to have a greater wear and tear. So you need to be prepared for the fact that it is going to cost you more money effectively to maintain that property and keep it in a really good order. But I would say one of the top sort of concerns or risks, if you like, is not being up to date with the latest legislation and the rules, and there have been a number of changes over the years. So I would recommend, particularly where we will lend to first-time landlords doing HMOs, even up to our maximum 10 bedroom, that a letting agent is utilised, because they're doing this day in, day out. They're keeping on top of all the legislation changes. And because there's so many different areas where there could be selective licenses, etc., then the agents in that particular area will have that expertise and be able to help. And the same with the maintenance side of things. They will have specialists that they can go to straight away to get work done quickly. Whereas if you're trying to do it yourself, you've got to research and find these people. So having that additional expense of a letting agent, I would say, is definitely worthwhile, because again, if you're having a changeover of tenants, they can manage that and get people in very quickly. So
Okay, and I know when we've actually undertaken some HMO placement ourselves here at Crystal, I know quite often there are some significant or beneficial tax advantages, aren't there?
Yeah, well, I think from a HMO perspective, because obviously the tax changes have meant you can't actually have as many benefits as there were there for single let. But the key thing to remember when you're doing a HMO or multi-unit block for that matter as well, is that if the actual block has got communal areas and you're maintaining those communal areas and perhaps providing furniture, replacing furniture, then those costs can actually be set against your tax liability. So whereas things like that have been stopped for a single let property, so you can't claim for doing sort of maintenance to the same extent, with HMO and multi-unit blocks, that's still an option for you. So,
okay, great. And yeah, I think we were discussing when we were preparing for this how, looking at the originations that Crystal have had over the last 8-12 weeks, look, we're still, fortunately, pretty buoyant with, with bridging and some short-term funding solutions. But buy-to-let and particularly HMOs within that, that buy-to-let segment has become probably the second in terms of originations, just behind bridging with our products. So why do you think these rise in popularity and these an increased demand or originations for HMOs at the moment?
Well, we've seen a big increase of demand where perhaps someone has taken out a bridge with us because they've bought a property that needed conversion. We've seen a few pub conversions and things like that, where obviously they've been sold off.
Yeah, you inspect those ones personally, don't you?
Yeah, exactly. I have to visit them. But the good thing about that is that we will do sort of day one remortgages. So if somebody does purchase a property, we quite often get ones where they're purchased at auction. They do the development work as quickly as possible and then want to pull out the maximum they can. And we're quite comfortable with doing that. So I think that there has been quite a lot more linkage between our bridging team doing their bit up front and then us taking over the loan once the work's been completed. So
yeah, and also the affordable housing. So again, we've seen an increase in obviously the this stock in the marketplace. So we know the marketplace at the moment is limited stock, which is affecting the purchase transactions. We've seen this trend towards remortgage and refinance, which I think distributors and lenders alike have actually seen, which is great. But one thing we have seen, particularly on the HMOs, is the affordable accommodation types of properties. That's something you've seen as well.
Yeah, definitely. And we've also seen quite a few what I would class as different tenancy types. So a key area for us is that we will accept up to 5-year tenancies. And we do quite a lot with the local authorities. So where they need to have their housing claimants homed. So we were quite happy to accept those. But also we've done a few with Serco, where they're putting in asylum seekers into the property and they want to take on the property for 5 years. But more recently, we've seen quite an increase in charities where they're trying to help people get back into the community. And it can be a range of different types of people that are in those properties. So we've had like ex-drug addicts, we've had foster children that have sort of come of age so they don't qualify for fostering anymore but need obviously help getting their own accommodation, so the charities will help them. The key thing to remember with those is the maximum term we'll accept is 5 years, and we generally ask to see a copy of the agreement just to check that there's a suitable break clause, because sometimes you'll see that the landlord isn't able to serve notice for perhaps the first 2 or 3 years of the agreement, or even the whole agreement, so they can't serve notice within that 5-year period. That wouldn't be acceptable to us, because obviously if we were to lend and the worst was to happen and we did have to take possession, then ultimately we need to be able to serve notice and get access to the property. So that's one area that we just check on. And no onerous conditions. We did have one agreement from a charity where they were adapting the property specifically for these tenants. So they wanted assurance that if they were to take on this property, do the adaptations that were required, that they wouldn't be served notice. And it was actually written into the agreement that if they were served notice within 3 years, then they would be compensated for the work that they'd done to the property. Well, obviously, as a mortgage lender, if we had to take possession, we're not going to get into compensating people for works done. But in the end, the charity were fine, and they agreed to have that condition removed. So the other key thing for us is that we can't have staff in the property. So, for example, some of them need like warden assisted, where the warden will stay in the property, or if they need carers coming in 24/7, they wouldn't be acceptable to us. We consider that more of a commercial arrangement. But other than that, you know, the subletting, we've done it with letting agents as well, where a letting agent gets a number of tenants and they've decided, right, you know, rather than actually renting it on behalf of the landlord, we'll take the property on board. And obviously that gives more guaranteed rental for the landlord. So they're quite often happy with that. So yeah, lots of different options there.
Well, and look, I mean, being able to deliver facilities for, you know, charities and vulnerable, I mean, that must give you some great case studies, and it's, you know, must be very satisfying. I think, I suppose, like most, products that are available in the market, you know, brokers tend to, you know, really search for certainty of decision, you know, when it comes to that placement. And, you know, we know pricing is important. We know the criteria, you know, LTV is important, but that certainty is absolutely crucial. You know, would you say it's easier for brokers to actually place their cases now, and also easier for landlords to have a HMO property as part of their portfolio? So we've seen, so I know probably two questions I'm asking here, but we've seen obviously landlords look to diversify their portfolios to include a HMO, and we've looked for, we've seen brokers look to diversify, just maybe away from the resi into other areas. Are you seeing, is it easy for brokers and is it easier for the landlords, I suppose?
Yeah, I mean, I would say we're very good. Obviously, you guys know your staff, so you'll refer across to us any cases that we want to see for pre-agreement. So if it was a HMO and it was above commercial or something like that, we like to see those ones and confirm the maximum loan to value, so you can refer those across. And generally with referrals like that, we're back within a few hours. We don't take long at all. But also I would say generally for HMOs, the market has opened up quite substantially, and even this year really, where more lenders are taking on board that type of property. And as well as that type of property, you're seeing, like ourselves, we used to only go up to the 6-bedroom HMO, whereas now we go up to the 10-bedroom. We do ask that over 6, so from 7 to 10 bedroom, they're referred to us just so that we can have a look at it and make sure we're comfortable with it. But if you went back sort of a couple of years ago, it would have been very, very difficult, and you would be paying quite substantial rates to be getting a 10-bedroom HMO, and particularly if you're a first-time landlord. So I think the fact that there's a lot more accessibility to lenders being prepared to lend to those types of properties, it's made it more competitive as well. So, and I think, first-time landlords are quite happy. They look at it and think, yeah, actually, I can have an agent managing it all. So from my perspective, there's no additional work for me, and I should be getting a greater return. So, and we are seeing some very nice, what I would consider sort of high quality, because a lot of people have a perception, a HMO, it's student lets instantly. Student lets is poor quality accommodation and everything. But we've had one at the moment where, I mean, it is unbelievable, the grounds that the property have got, and they all have garden and looked up, really stunning property, high spec bathrooms, the kitchen's amazing. So, there is a strong market for professionals that can't afford a property of their own, or perhaps want the company of other people. So I think the market has opened up and become a lot easier for landlords.
Okay, great. And look, we're starting to get the questions coming in from the audience, which is great. I've just got one more question that I prepared before we go to a few from the audience, and it's just in relation to I suppose the recent changes to planning permission, really. What impact has those changes actually had on the opportunities for HMO investment?
Yeah, it's a little bit more difficult now. So in the past, you could almost just alter if you had a large property, you could just alter it slightly, perhaps put a few locks on doors, and away you would go, and you wouldn't need to worry too much at all. It isn't quite like that now. Obviously, there's various different, the mandatory HMO licensing, but you've also got the additional licensing as well, and there can be selective licensing in the areas. So it is quite important, and that's why I was stressing about having an agent that's fully aware of the areas and knows what's required. And one key thing I would say is, if it's a new purchase, we would require that they apply for a license on completion, but obviously we don't need to see a license. But when they own the property, we will be looking to see the HMO license, and we will be checking that the license does allow for the number of tenants they've got in the property. And sometimes we get it where it's an 8-bedroom, but the license only allows for 6 occupants. Well, we would require that license to be amended to reflect the fact that they can have 8 in there, because as a lender, if we just said, oh, well, they're only going to have 6, well, one, what they're going to do with the other 2 bedrooms, but we've no way of really policing that and ensuring that they are only having 6 in there. So things like that we would pick up during the processing, and obviously the solicitors would need to verify those sort of details. But it is very important, because every area is different. Unfortunately, they all have different rules. So it's not like you can think to yourself, oh, I need to do this, that, and the other, because it could be completely different for the next property that you go to purchase. So you need to be a bit careful.
Look, again, I think this is where, I suppose, liaising with an expert is really important, isn't it? So again, I think we've got a tremendous mortgage desk who can help facilitate and provide the pathway for the advisors that are listening now, and guidance there, and obviously providing the solution for you guys are there to provide the solution. But I think being able to make, I suppose, complex situations simple is a real requirement of our team and the mortgage desk here.
Yeah, exactly.
I think, as I said, we've got a couple of some questions coming in now, which is great. They're from anonymous attendees, so I can't actually name the people who are sending these, but kind of linked to you referenced first-time buyer just a moment ago, or first-time landlord, and the first question is, can a first-time landlord start with a HMO with West One, or would they have needed to have maybe owned a buy-to-let portfolio or some buy-to-lets previously?
No, not at all. So this could be their first buy-to-let purchase, and they've decided to purchase a HMO. So yeah, they don't need to have already had a buy-to-let already, or have any sort of experience like that. So yeah, it keeps it very straightforward for them. Right. I think that's why more people are doing it, because I think, like I say, if you went back a couple of years ago, you would have lenders saying you must have one already. Well, it becomes quite difficult, doesn't it? You want to get on that bandwagon straight away. Yeah. So no, with ourselves. Brilliant.
That's great, isn't it? So great. So you spot on an HMO opportunity. You can immediately, as long as you got the deposit, you can immediately look to source it with Crystal, and we'll place it with West One. There we go, job done.
That's right, up to the 10 bedrooms as well.
Love it. Okay, love it.
On that even.
Next question's from Richard, and it's kind of linked to what we were just talking about the licenses, really. So using the 6 and 8 bedroom license on a purchase, what happens if the local authority does not give approval? So what's the situation? So using that 6 and 8 bedroom license on the purchase that you've just been discussing, what happens if the local authority just won't give the approval? How will you know about that?
Well, as if it's owned, then like I say, if they were applying to us and they only had a 6-bedroom license, but the valuer was saying it's 8-bedroom. The other thing is the valuer will comment on the room sizes. So effectively, if there's a room that isn't big enough for a bedroom, then they would tell us. So there's that factor that we're guided by what the valuer has to say. So if, for example, they had a very small box room that couldn't be utilised as a bedroom, it was just far too small, and it was being used as a room where they had a computer or something like that, and that was very obvious, and the valuer was quite comfortable, then that wouldn't be an issue. But if it was a room that, you know, quite clearly could be used as bedroom, the room size is sufficient, but they'd only applied for 6 because perhaps at the time it was, you know, easy to get a 6-bedroom, but you would struggle to get 8-bedroom, for example. That situation, we would generally be asking for them to get that amended. So it depends whether they own the property or if they don't. If they don't and they're purchasing it, then we would tend to just make it a condition of the offer that they must have applied on completion. So, you know, if there's a problem down the line, then that will be post completion anyway. But if they own the property, obviously they've got the ability to apply. I mean, we have had ones where, like I was describing, a developer has converted the property, they've applied for their HMO license, they've come straight to us, want to pull out the cash, and effectively we've been told by the council, yeah, we've got a 6-month backlog. Well, we're not going to delay a mortgage because the council's got a 6-month backlog. We will take the guidance of the valuer, so providing the valuer doesn't make any adverse comments and says they're not going to get a license on this, then we would proceed with that case. I mean, obviously, if there's issues raised in the valuation, we would have to get those addressed.
Okay, all right, there we go, Richard. So hopefully that's answered that question. Just before we move on to maybe some criteria specific questions that I've got, just got another question in from our friend, the anonymous attendee. So can West One help with funding to convert a property into a HMO? So given the legislation, so again, kind of linked to what we were talking about with the with the planning. Yeah, would this be possible without changing the footprint of the property or without requiring heavy refurb? So just read that again for you. So can West One help with funding to convert a property into a HMO, given that the legislation has obviously been changing? Would that be possible without changing the footprint of the property or without requiring maybe heavy refurb work?
It very much depends on the individual property itself, doesn't it? I mean, if it is a large property and, for example, all they're going to really need to do is put locks on doors, but there's a nice big shared bathroom, you've got a shared kitchen, etc., then yeah, that's quite possible. It depends on the level of work that's required. If work is needed, if the valuer says work is needed, it would depend on the degree. So we do have a policy where we can look at light refurbishment works, and then we would generally look at 70% loan value. So if we know, for example, somebody said to us, right, we're going to put a new kitchen, new bathroom in, it's going to take us a month to get this work done, it's going to cost us £10,000, we would generally cap that at 70% loan to value, and we'd want to see that they've got savings to do the work. The thing to remember with that is we are basing our value on the current condition, what the valuer is telling us what the current condition is. So what you tend to find is, because people want to maximise on what they can get out of the property, that scenario is quite unusual. What they'll tend to do, if they're purchasing it, is bridge, get all the work done, because then we can base it on the enhanced value straight away.
Yeah.
And they want that extra outfit straight away. So that or certainly more recently has been the most popular option, to get the work done on a bridge and immediately remortgage it. But yeah, the footprint and that sort of thing, a lot of it will depend on the room sizes. If the room size it's a nice big house, then you shouldn't really have any issue. We do generally ask for there to be a shared kitchen. If it's a shared kitchen dining room, that's fine. If it's a small kitchen, then we would normally want a shared lounge as well. So again, it really depends on the setup of it.
And Annette, Harvey Sander had asked about the minimum room size. So you mentioned the room sizes there. Is there?
Yeah, I have got the minimum room sizes written down because I never ever remember them. Where have I got that written?
Crystal ball. So there we go. You'd forecast this. Just like
so minimum room sizes for one adult is 10.22 square meters. For a single adult, it's 6.51. Which I thought was a bit odd because obviously they expect you to be cozying up, don't they? Because it's not double. Yeah. But for a child, it's 4.64. And
okay.
So when the valuer goes round, he will be checking when the minimum room size is. So if there was a room that was 5 square meters, he would be saying that's only suitable for a child, yeah. Which isn't a problem for us if they've got the license that allows for the necessary number, then that's not a problem. And the other thing to remember with HMOs is that if it's up to 5 bedrooms, we would normally only expect 1 kitchen. From 6 to 10 bedrooms, we can look at 2 kitchens, and we will accept kitchenettes. So I've just done one at the moment where it was 8 bedrooms, and each bedroom, it had like a small sink unit and a microwave and a fridge. And that
okay.
So it didn't have a cooker, so if it had a gas cooker in there or something like that, that wouldn't be acceptable to us. But if it's something that effectively isn't really affecting the fabric of the building, then we would be okay with kitchenettes like that. But they wouldn't accept a built-in oven or anything like that.
Okay. I said we'd move into, I suppose, some criteria questions, and Peter Howard has asked a question, just regarding the, I suppose, relevant to the income really. So is there any requirement for a landlord to have earned income to support an application, so other than the rental income? So what's the West One view on this?
So we don't have a minimum income and generally don't require evidence of income. However, they do need to have an income that they can declare. And if they only own 1 buy-to-let, we wouldn't accept just rental income. If they had a portfolio of properties and that was their only income, that's fine for a portfolio. But obviously, if they only have 1 and they're looking to mortgage that and the rent's not paid, well, they've lost their income and they've lost the ability to pay us. So, we don't have a minimum income. It's just the underwriter will assess the case and just make sure they feel comfortable that they will be able to continue meeting their outgoings. And if the tenant doesn't pay the rent, will they be able to pay the mortgage? So as provided the underwriter's happy with that, and we'll accept pension income, that it could be an investment. Obviously, they could be self-employed. It could be a mixture of income, and they will just declare on the form what their total income is. As I say, as a general rule, we don't evidence income. The only reason we would normally look to verify income is to verify they're a basic rate taxpayer when they need our lower rental calculation. So generally, for a basic rate taxpayer and limited company, it's 125 on a single let and 135 when you're doing it for an additional taxpayer. So if it doesn't fit on that higher calculation, then we would look to evidence they're a basic rate taxpayer, and that would be it.
Yeah, I mean, look, I think what we found over the last 12 months, 18 months dealing with you guys is there's a real flexible approach, and there's an appetite to find ways to do the deal rather than not do the deal. So that flexibility,
because
firsthand.
Furlough, I would say, that didn't really impact us at all, because if somebody was on furlough, then ultimately they're still receiving an income from that employer. And we took the stance that, well, they're going to be returning at some point. Obviously, now the scheme's ended, then if somebody said, oh, yes, we were on furlough until the end of September, we've literally just gone back, then the underwriter might ask for one pay slip for this month to confirm they've gone back.
Yeah.
But that's it, really. It's not had any impact on us at all. I mean, obviously, don't know what the general impact is across the market until we see the unemployment figures and that. But
yeah, well, look, we know certainly firsthand that the approach you guys have taken has been far more flexible than some of your peers, which is encouraging. We've also seen, here at Crystal, we've seen a huge increase in foreign nationals over the last few months, and we've just looking at completion figures for last month, we had a fairly high percentage of people who've actually not set foot in the country, and we were delivering completions too. But we've obviously got these the people who maybe not got full rights to reside, and there's been some opportunities we've been able to deliver for those. What's the West One view on the foreign nationals?
At the moment, we don't have a foreign national policy, so we wouldn't be able to assist if they didn't have indefinite leave to remain in the UK. But I know that's something that's on the radar for Andrew, so he's working on that at the moment. So I would say watch this space on foreign nationals. But another big growth area for us has been our expats. We've seen a huge increase in expat applications, and because we will lend both within the EA, and if it's outside the EA, they need to refer the case across to yourselves, and then we're doing AIP. But we've done, well, so many countries, I can't really name them all, but Australia, New Zealand, USA is really popular, Dubai, Hong Kong. So, just refer them across to you guys, and then we can do an AIP on it. Generally, we're looking for them to be employed by a recognisable firm. Yep. But again, that's very case by case, because if they've got a portfolio in the UK and they're looking to perhaps expand that portfolio and they've got reasonable income, then we're actually not so worried about what they're earning abroad. So if they're self-employed, but they've got a portfolio, we've still done those sort of deals. So I would say refer it across, because like you say, we try and be flexible and do the deals we are. So if we can get comfortable with it, we will. We are generally looking for them to own one buy-to-let in the UK already. And we used to say that it must be mortgaged, because although we don't credit score, it would help the underwriter build the picture for the credit profile. But again, we've done quite a few where they own it unencumbered, but we've still got various different credit transactions that we can get comfortable with. So
great. Just coming back to the income calculator, and I know we were talking about letting agents, and again, Richard Johnson again just asked, is there a deduction applied for the letting fees?
No, so we always base our lending on the figure that's confirmed by the valuer. So That's down to the applicant's choice whether they decide to instruct an agent or not. So the fees don't come into that at all. Okay,
and we mentioned before about first time. That borrowers can become a first-time landlord for HMO. They don't need to have had a buy-to-let in the background. What if they are not currently a homeowner? So they've maybe been a homeowner in the not too distant past, but here and now they're not a homeowner. What would the view be around the ability to procure a HMO?
It would depend on the circumstance. So if we can actually get a mortgage payment profile on that, and then, perhaps they sold that property, they've still got the funds that they had from it, but for whatever reason, they don't want to buy a residential now and they want another buy-to-let. As long as the underwriter's comfortable that it couldn't be perceived as a backdoor resi, then that is something we can look at. And what we tend to get quite a lot of is where they've already let their property, they moved into rental quite often because they've moved with jobs and they weren't quite sure where they wanted to be. And so because we can get a rental profile on that new property, then we're happy to take over what was the residential, because they tend to just leave it on consent to let. then we can take that over. So if it's an established situation, we're comfortable with that. If, for example, we get quite a lot of people asking to do a let to move, we call it, when they want to let their existing home onto a buy-to-let, but they're moving back with mum and dad, that they're not comfortable with at all. They just see it, well, if the property is not let at completion, and if they move back with parents, the property's still not let, and think, oh, I can't cope with being back with mum and dad, I'll move back into the property. They just perceive that risk as too great. Whereas if the property's already been let, they've already got an established situation, they've been back with mum and dad for a year or whatever, they're more comfortable that it's not a recent change that might not work out, if you see what I mean.
Well, you know what? That's kind of linked to Gavin Royal's question, or it's not that kind of linked. It is linked there because Gavin's got a client who, I suppose, in the circumstance we've just been discussing there, he's selling his residential property and moving back in with his parents because he's just split with his partner. But what he's looking at doing, so he's in that residential property, or he's in that property with his parents at the moment. That residential one is not yet sold, but he's looking at purchasing a property which is a HMO, it's already occupied and already tenanted. So you've probably got a few different dynamics working there. So you've got this marital split which is taking place. You've got a situation where the borrower has moved into his parents' property, and you've also got an existing HMO already occupied that he believes is a particular good purchase, and he wants to try and do that. But there's a couple of things sitting in the background. What would you think on that?
Yeah, if he's only recently moved in with mum and dad, so it's not, the underwriter wouldn't really consider that to be an established situation. I would say no, that's not one for us. If he's been with mum and dad for some time, and we can still see the previous mortgage payment history, etc., then it's something that they would consider because it's an established situation. But it really depends on the circumstances, why he wants to buy another buy-to-let, or he wants to buy a buy-to-let rather than a residential and live with parents. They just need to understand and feel comfortable, like I was saying before, that it wouldn't potentially be seen as a backdoor residential.
I think between us, with that particular one, Gavin, I think between us, whether it's Annette getting comfortable with the time period that the guy's been living at the property, or whether it's using Crystal to maybe place it. I'm sure there's a deal in there somewhere. So
I mean, ones we have done was where they've been moving in with partner, but actually they've been going on the mortgage. So effectively that is let to buy because although they're not buying a brand new property, it's the partner's property, they're buying into it, so that's not an issue at all. It is this new scenario where we class it as let to move, they're just moving somewhere because there's not that commitment to stay in that property for any length of time, and if things don't work out and the buy-to-let's still empty, it's
get it.
People to move back in.
I mean, as we've gone through the questions so far, and as you've delivered your answers, I've actually scribed through a number of these criteria questions because you've done a sterling job answering them already. But just looking at a few of them here. So the view, if the HMO is let to the council. So I know council was referenced earlier, but what's your opinion? What's your view for in those circumstances? So it's immediately let to the council.
Yeah, we're fine with that. Like I said before, generally they're looking for it to be 5-year term, which is fine. We do ask to see the agreement just to make sure there's a suitable break clause. But yeah, we've had a lot of those without any issues at all. So I'd say they're quite standard really for us.
Yeah. And what about, I mean, look at, I had questions about number of occupants, I had questions regarding number of bedrooms. Again, you've answered those, the 10 bedrooms and the 10 occupants on the license. What about accepting HMOs if the self-contained units, so hybrids of HMO and maybe the multi
so almost what we've done a fair bit of is where it's a multi-unit block, but within that multi-unit block you've got 2 or 3 of the units being used as HMO because they're nice large units, and then you've got single let units as well, and that's fine by us. Again, when they're being valued, The valuer will need to have access to all of the units, and they will report to us on the sizes, etc. The thing to remember, if it is a number of units like that, generally we're looking for each unit to be at least 30 square metres. Well, if it's a HMO, you know, that's generally not an issue at all. But if you've got a mixture, so say you had 10 units in a block, you had 4 quite large ones that were being used as HMOs and 6 that were smaller, and a couple out of that 6 were below 30 square metres, we can look at those. We just need the full referral across to us, and then we'll confirm what the maximum loan value we can do. The good thing is that we have our own in-house valuations team, and I would say that's invaluable, particularly with unusual property types, because we get a lot of declined valuations referred to us where another lender said, no, we're not happy to lend on this property. I had one this week where I thought I knew the area really well because it was in New Shot, which isn't very far from here. And the valuer had basically said, no, you can't lend to this property. I'm not recommending it as suitable security because it's got 1.5 acres of land and therefore it's not a buy-to-let. It was already let as a buy-to-let. Like, really? You know, this is a lovely area, lovely property. And I referred it to the in-house valuers and said, I can't see anything wrong with this at all. Can you let me know? And they came back and said, yeah, you could say it isn't a traditional buy-to-let because a lot of people don't want properties with that amount of land with them, but some do. And this is clearly already let, and yes, we're happy to lend. So sometimes I think it is a bit difficult with valuers. Valuers, you know, if they take a disliking to a property, it can be a real problem. I had another one declined by another lender because the valuer again said, no, I don't think it's suitable because it was above a convenience store and it had a vape store next to it. They said they wouldn't lend on it at all. And we actually said 75%.
Great.
In Egham in Surrey, really popular area, fantastic rent return, but another lender had completely declined it, said they wouldn't lend at all. So I do think sometimes it's almost the luck of the draw. If you get a valuer on a bad day and he doesn't like a property, then you're going to struggle. But I mean, I always sort of think, oh, I shouldn't really say who the valuers are, but because they're not on our panel.
Go on, name and shame.
Well, at least I said to the broker, you don't need to be worried that it's going to be the same guy that's going to go out because we haven't got them on our panel. So, you know.
Great. So not only have we got a flexible approach when it comes to how we assess income and how we assess the customer profile, this flexibility with the property type is something that, you know, is a real distinguishing feature for West One.
Yeah, I'd say we definitely pick up a lot of business that other lenders and new build blocks as well. I've got one at the moment that I've just referred to the in-house valuation team because it's 54 floors and the flat itself is on the 44th floor, and the service charges, the ground rent and service charges are a bit high to what we would normally expect to see. And I've had a few where I've referred them and they said, oh no, for that type of development, we're fine. But with new builds, we like to check the exposure as well, because this one was in Manchester and Liverpool. We've had, because we've got no limit.
Careful, it's my hometown. So careful.
Yeah, well, it's very popular at the moment.
Yeah, good.
I was in Liverpool last week and the amount of development, I haven't been there for 2 years and I could not believe how much development in 2 years. It's incredible. But where we don't limit the number of stories on a block, and because we're comfortable with there being commercial on the ground floor, we seem to get a lot of those. So, but again, we can refer them to the valuers and let you know.
And look, it's terrific to see, isn't it? This investment in, you know, these northern towns and the Midlands towns is terrific to to see. I mean, we were over in Digbeth in Birmingham last week, and you know, all the investment there on the back of the HS2 was terrific. The spinning fields and in around the docks area, well, spinning fields in Manchester and docks area of Liverpool. There's so much going on, and it's just terrific. And I think, I mean, we'll talk about trends and maybe what our own forecasts are in terms of the optimism we can have over the next 12 months, 18 months in a moment. But if Dick has asked about the end of the furlough scheme, and I suppose what your opinion is in terms of the impact really. So the stamp duty freezing. So look, we've both our businesses have been blessed to see the benefits of the two stamp duties. And that we've seen in March and June of this year. But furlough is it's imminently closing, and obviously we've got the freeze now on stamp duty. So what's the West One view and forecast and the net view?
West One, we believe it's going to be a very strong year next year. I mean, we've got big growth plans ourselves. I mean, it was interesting because I was at a couple of events last week, and speaking to a few people there was a feel that it is going to be quieter next year. I mean, I was quite surprised. One person I was speaking to was saying, "Oh, we're estimating a 20% drop on this year's figures because of the stamp duty and everything." They feel that that's really enhanced this year, and because there's not going to be that next year, then they're predicting this drop. But certainly we haven't seen it. We haven't seen a tail off. We've seen less purchases for sure, 100%, but not the tail off of the. I mean, I was talking to you earlier saying it's so busy with inquiries, and sometimes they are complex, so they do take a bit longer, but we haven't seen it. And definitely portfolio landlords, since we increased our portfolio limit to 5 million, I think we've done about 6.5 for a few landlords already, because they like to push the boundaries. And so the portfolio landlords seem to be very keen on developing their portfolios. There seems to be no lag of, no, we're going to hold off and see where we go. They're just cracking on.
And you know what? I think we share that optimism. I've been in this marketplace over 25 years, and I know I don't look old enough for that to be the case, but
not me.
Thank you. And look, we know the market's cyclical, and we also know that the end of furlough is going to push people who might have otherwise been prime and vanilla customer profiles into a specialist space. And I think those niche areas that that we operate in, that specialist space that we operate in, I think we can be really optimistic, not just for the next 12 months, but I think the next 3, 4, 5 year period that we're actually in the marketplace. I think there's a lot to be optimistic about, and specialists, I've got absolutely no doubt will have a huge part to play over the next 3, 4, 5 years. We've still got 300,000 houses that the government want building next year. We'll be lucky if they do 150, 180. So, but that's still 150, 180 new build properties coming into the marketplace. So whilst the purchase market might be struggling a little bit in terms of stock, it'll find its level, and with the new build stuff, I'm sure we can be really optimistic about the next few years. So I think it's a brilliant place to be working at the moment. So I think we're on the same page with that. What about any specific trends and maybe things that you're seeing at West One at the moment that would maybe some of our audience and attendees should maybe consider? So look, we know we've got permitted development, which is having a beneficial impact in the commercial space. What about in the HMO space in terms of maybe trends or things that the guys should really guys and girls should be looking out for?
Well, HMOs, like I've said, we've seen a huge increase in the number of people applying for that type of property. And I think that will continue because the demand for affordable accommodation is not going to go away. And obviously landlords can see the benefit of the increased rental returns, etc. I mean, from the levels of business that we've been doing at West One, we've seen a big increase again this year on holiday lets. They've become very, very popular. We also do those for multi-unit blocks again now. We sort of stopped that for a while over COVID, but that's been reintroduced, going up to 75%. So holiday lets are massive. I already mentioned the expats have been very, very popular. But I suppose the hot topic at the moment are the green mortgages. Everybody seems to be bringing out these green mortgages because I think people are more focused on making properties more energy efficient. improving the EPCs and then getting a bit more of a beneficial rate, because that's going to appeal to a tenant far more if they look and think, oh, it's going to cost me a lot less to live there. I'm planning on staying here for a number of years. Yeah, I might as well go for a property that I know my bills are going to be less. Then that's going to appeal. And certainly the majority of lenders have got, if you've got a property A to C EPC rated, have got a preferential rate. You know, our best rate is for that green product. So I think that will become more and more popular as people decide.
It's an interesting one. That green one. I was at the Senate a couple of weeks ago, and a few people were talking about the green mortgages. And you know, for me, great to have a differentiator in terms of the price, but it's got to be meaningful enough. So if it's a 1.2, I'm not sure it's really going to excite the borrower. So I think it's got to be a meaningful difference. And I've got a couple of pals at the moment. I've got one particular pal who's got a £500,000 worth of rental income coming in each year, which is terrific. But he's got probably a £270,000 cost of maintenance, which is actually only going up each year. So I think he's of a certain age, so he's older than me, but he's kind of at an age where he's really asking himself whether he does want to, is it worth growing the portfolio anymore? And he's probably not. So I suppose when we're looking at I suppose the future, I can see the borrowers being there'll be a younger age, and I think there'll still be a mountain of opportunities that are actually available. But I just think coming back to the green, just that rate just needs to be meaningful enough for it to be eye-catching and worthwhile.
Yeah, I think we've done a combination of the rate and the fee being slightly less to try and incentivize them. But you're right, again, it's about the right property and the cost involved, isn't it?
Yeah.
What can they do to actually improve it? And if they can do that for a very reasonable cost, then they're going to do it. If it's going to cost them a lot of money, unless it's exempt, of course, and we've had a few of those types of properties where they've just been exempt, so they didn't need to worry about it. But
got it. And some of the I suppose last probably question from anonymous is just really regarding the declines for adverse credit, and again coming back to the customer profile, really. So coming back to the customer profile, so we've said whether it's because of furlough or whether it's just because of the events of the last 12-18 months, we are going to see maybe some customers with a blot on the landscape which is caused by an event. So they're not habitual poor payers, they've just had an event which has caused a mishap. What's the West One view to those types?
Well, that's quite an interesting one, because we are reviewing at the moment. We've got W1, W2. So W1 really clean credit profile, and W2 is for people that have got the odd credit blip. And one of the things that on W2 we'll accept is if somebody's got a CCJ or default, and it's up to £350. It doesn't matter when it was registered, whether it's satisfied or not, that's ignored as a one-off credit blip. And we haven't got that on our W1 product range. So part of this review is that they will be looking to allow for that credit blip on the W1 range. So it will still be for clean clients, but they will allow for that credit blip. And we're also looking at increasing the 350 limit to make it slightly larger. And the other thing with ourselves is even sometimes on the credit search, it might show that they're 1 month down. But if we get evidence that they paid it within 30 days of the due date, we just ignore that. We don't class that as arrears at all. So they just need to provide us. So if it was a mortgage payment, what the due date, a statement or something to show what the due date of it was, when they actually paid it. And as I say, if it's within 30 days, that's just ignored. The same with credit cards or any financial transactions. If the credit report is showing that they're 1 down, but they can evidence actually it was just a late payment, we completely ignore that. So it is worth having those conversations, because sometimes people will just get the credit report and take that at face value and think, oh, they've had arrears here, they've had arrears there. if it's paid within 30 days, we don't class that as arrears. So that's quite a key point, really, because obviously it can be the difference between whether it goes on W1 or W2.
Okay, great. Just, I'm conscious of time, so we've got a couple of minutes left. So probably final question before I look to summarise, and you can plug the gaps in anything I miss out. So we fast forward 12 months, and we're looking back on 2022. What would you like to have seen in the HMO market? So where would you like West One to be, and what would you like to have seen in terms of maybe transactions, and whether that HMO space actually is in 12 months' time?
I would definitely see it growing with us, without a doubt. And I think it would be nice to see, certainly with ourselves, I think I mentioned we have Metropolis and appraisers who do our valuations at the moment, but we'll perhaps be looking at having an additional valuer on panel. And I think really getting the turnaround times back from valuers down on HMOs. And that's one area where I would say, as a landlord, if you're mortgaging a property that you already own, put those tenants on notice and get that in with them, so that, because the first question the surveyor will ask is, have you been made aware, have you been put on notice of that we need to do this inspection? And if they say no, then they have to book the appointment after giving them the relevant notice period. Whereas if they say, yeah, oh no, the landlord's already told us, they can literally book it for the next day if they've got space. So that's quite important. And also, you know, if the landlord knows that they've got tenants that aren't particularly reliable, I would suggest that if there's quite a few units, that they try and make arrangements for an agent to be there or something, because we do get valuations that are held up because we require the valuer to have access to all the rooms where they go, and 5 of them will let them in and 3 of them aren't there, and they can't get access to those 3 rooms, so they have to do another visit. So those it's silly little things really that can actually make it a lot easier for everybody if there's just a little bit more thought and organisation around that sort of thing. But yeah, I would say from a personal perspective, that's the main thing I get involved in, with valuations and issues and how long they take. So that's one area I'd love to see that made a little bit slicker and smoother.
Okay. Well, if I summarise now, so look, that's been absolutely brilliant, and we're 1 minute over, so yeah, it's always a good sign. So fill in the gaps for me. So anything I miss out, really, for filling the gaps. So, you know, what I take from today and what I take from the experience in dealing with West One is that there's a real expertise when it comes to property, and you particularly love HMO. So when we look at buy-to-let and we look at you know, even the niche within buy-to-let, which is HMO, there's a real, you know, experience and expertise that West One have, which is, you know, almost second to none in the marketplace. You've got huge appetite to lend, so the ambitions for the next few years is absolutely massive. So again, we know the guys leading the business, and we know how dynamic they are, and how ambitious they see the next few years, and see a marketplace probably similar, overlapping like ourselves, which is going to be buoyant, particularly in that niche and specialist space. You've got a sensible approach when it comes to customer profile and affordability, and, you know, importantly, there's a real flexibility when it comes to the security type. So logical, sensible, huge appetite, love HMOs, are key takeaways from me. So is there anything else, anything I've missed?
No, I don't think so. I mean, the feedback that I get from a lot of the people that I deal with is we really like dealing with you because we can talk to you, we can have a sensible conversation. It's not just, oh, computer says no. So, and that's one of the reasons why I like working for them, because it's not quite as good when, you know, it's computer says no. At least we're able to explain and justify the decisions that we're making. And another area that I get a lot of very positive feedback on is chasing through completions. Most people that I speak to say, golly, you're the only lender that I know that actually actively chasing and saying to us, when do they want to complete? And so yeah, that's another real positive for us, and I think that's what's sort of really driving those numbers up. And
great,
like you say, try and hit those targets.
Well, look, we've got a terrific relationship with you guys. We can build on that, I'm sure, as we move forward. Anybody listening today, obviously, at Crystal, we've got a brilliant mortgage desk. We've got a brilliant online hub which connects you with underwriters. So any of these complex cases where you want a sounding board, you want to understand whether it's going to fit, whether it's not going to fit, then we'll be quick at delivering those decisions either way. West One feature hugely when it comes to HMOs and buy-to-let as you would expect. And as I said, we're delighted to have the relationship we've got with yourself and the team there. So look, really appreciate your time today. Really good session. Hope everybody's enjoyed listening. Thank you for the questions. We'll make sure as part of the post event, we'll make sure that if there was any questions we've not covered, we'll answer those as well. But I just thank everybody for listening. Thanks for Annette for giving her time up. And I'm sorry you've not seen Chris Corns and you stuck with me today, but hopefully that's not been too much of a chore. And just really thank you for the time.
Thanks for inviting me. Much appreciated.
So thanks everyone. Have a good day. Have a good day.
Have a good one.
Thanks guys. Bye everyone.
Bye. Bye.